Um, Hey, everybody. My name's Chris McCann. Thanks for having me here. Thank you, Shinju, for introducing me. I guess my talk is all about tips for pitching. I guess this is mostly constrained with pitching your startup to VCs for capital, although you could probably apply a bunch of these things to other things, whether it's to foundations or grants or sort of anything. So I'll try to generalize it a little bit. But I guess before I start, a little bit about me. I run a VC fund called Race Capital. I used to work at Greylock Partners. Before that, I was actually a founder myself, so I started one of the earliest tech newsletter companies called Startup Digest, which was acquired by Techstars. So I guess I've been on all sides of the table, if you will, both pitching myself and then also now kind of on the receiving end, both at a bigger fund and now my own fund. And I guess really just short on Race Capital, we're focused primarily on pre-seed, seed investments, leading, co-leading rounds, and then infrastructure broadly. And then I guess what makes us maybe a little bit more unique is we do investments across Web3 and Web2. So anything around data infrastructure, transaction systems, developer tools, payment infrastructure, kind of all this low-level systems type stuff. This really tends to be our sweet spot. So that's us, or at least the context for you guys. So pitching. I kind of, for at least pitching, I sort of like to think about the goal backwards. And again, if you constrain this to kind of pitching VCs for capital, usually your sort of topmost goals, if you will, is eventually you hopefully ultimately want to get investment from a partner who you ultimately like at the best terms for you and your company. And then you can kind of work backwards from there. So with a pitch now is usually constrained sort of on Zoom, about 30 minutes, usually kind of an intro call. And with the intro call, the goal is hopefully to get to the next meeting. It's not necessarily to drive a decision within a 30-minute sort of short constrained time. It really is basically to get the other party interested enough to want to learn more and take another call, hopefully with other people kind of on their team or their other partners. Secondly, I'd say this is more like an underappreciated side. The goal of pitching is not just for you to tell your story, but it's also to ask questions from the VC partner too, to make sure that you guys both like each other and that you guys are a fit for each other. You could almost kind of think of it like dating to some extent. It's like a first-time date. You're just not throwing yourself out there. You want to make sure your other partner, you like them too. And then I guess another thing, unlike dating, is once you get married with your investor, it's really hard to ever divorce. You're sort of stuck with them. So you better make sure you pick somebody you like, or I guess you're going to have kind of a bad time, at least for your company. And divorces are messy, regardless. And then eventually, at the end of it, you kind of want to get to some sort of terms, if you will. So that's usually either like the structure of the investment, whether it's just a pure token agreement or safety or sort of equity round or whatever. And again, usually this comes after the first conversation, and this is kind of more done better on a one-to-one basis. So I guess thinking about the goals in mind and stepping backwards, I like to, I guess, lay out almost like the sort of framework or narrative for how to tell your story. And again, usually with startup pitches, this is like just kind of an example framework that you can kind of think about. So your team, the problem, the product, a demo, traction, the big picture. I don't know why it's cut off, but it's OK. Competition, investment, and then what are you looking for? Instead of talking about these abstractly, I might do the hard exercise of trying to narratize some of this in a make-believe pitch. So I'm going to make up a company right now on the spot and try to pitch it within this framework just for you guys to get a sense of kind of what this sounds like. So I'm going to pretend this is all make-believe. Feel free to disregard it all. But imagine I'm an engineer at Coinbase. I'm working on Coinbase Earn. And I'm going to leave Coinbase, and I'm going to start a lending protocol focused on sort of KYC or permission lending. So this is who I am, and this is the problem. I tried to launch Coinbase Earn at Coinbase. They have to go through a lot of regulatory scrutiny. It was very hard to do this within the company. So this is why I'm leaving to start this on my own. So I have a lot more freedom and flexibility for me to build my team around it. The product, we are pre-sort of launch. So there's no numbers to look at, but we built an MVP. We scoped out what this looked like from the consumer side, the lender, and the lendee side. We have a mobile app. Let me show you a little demo of what that looks like. And then usually sort of in Zoom, you would share either your laptop or your phone, and you would kind of walk through sort of visually what this may look like. And this is important because you don't want to just talk about how you've thought about this in theory, but you want to show some real code to paper, if you will, to show that you've thought about how to take this big idea and construct it into a sort of MVP. And a traction, so traction is either talking through your numbers. So I can say, hey, even though we have not launched, we've already built an MVP, we talked to a few lenders, we built a community, we have a Discord group, and here's sort of all the people that we have who are interested in this thing that I'm building. And in the broader, bigger picture, we think the lending markets are still very underdeveloped in the Web3 space. If you look at the lending markets in the traditional markets versus the crypto markets still have a long way to grow. And we think this permission side is like a sort of a really big underexplored area. When you look at some of the competition, like Aave or Compound, again, these are doing it from a completely decentralized sort of fashion. But from us, we're doing it this permission side, which when you look at sort of other comparables, this is just a very kind of untapped market. We're raising our pre-seed round. We want to raise $2 million. We're looking for a lead investor, ideally somebody with lending experience, somebody who knows this market and wants to be a partner to us and kind of help us with it. I made all that up completely. But this is just a kind of a narrative structure for how you would tell your story and sort of how you would fill this out to kind of talk through on who you are, why you're doing it, where you are, what this could become, and what you're looking for. And ideally, if you can constrain this all within 10 to 15 minutes, which is sometimes harder said than done, then you leave enough time to have questions on the other side, for you to ask questions from the investor, and you to figure out, again, if they would be a good partner for you. Because ideally with a pitch, again, it's not just you sharing your story. You're also trying to get feedback back from the other side. So yeah, maybe to recap. So typically how these kind of investment process pitches goes is usually there's this intro call. If the partner is interested, they would usually bring their team on to have a second meeting, usually 45 minutes to an hour to kind of dive a little bit further. Hopefully, most investors are doing some basic due diligence. So some technical DD, references, customers, partners, references on you, references on some of the customers you're working with. And then if the investor decides they want to invest and you, the founder, decide you want them to invest, then you would kind of go more into the negotiation side. So the terms, how much they want to do, amount, round structure, sort of all that stuff. And then all of this gets memorialized into a term sheet, which the investor gives you, the founder. You have the choice if you want to sign or move forward with that or not. And then there's kind of final legal DD, which hopefully all investors do, which is kind of more on the legal cap table side. And then all this gets turned into long-form docs, which both parties sign, and then you get wired a check. So this is kind of how sort of the investment process flows from the venture side and how the venture investor kind of thinks about it and all that. And then I guess sort of being on the receiving end of a lot of these pitches, especially a lot of these intro calls, I don't know, about 6 to 7 sort of intro calls a day. I guess there's just a few observations I have to share from being kind of on the other side of a lot of these things. So one, again, keep in mind the goal of these first initial pitch meetings is just for the person to get to know you a little bit more in your story. It's not to go through everything about who you are and where you came from and your full life story and where you were born and what you had for breakfast and everything else. Sometimes, a lot of the times, the entrepreneurs tend to kind of go into who they are for 10 to 15 minutes, which kind of eat up about half of the call. I would constrain it to just kind of more of the important stuff and not go into belaboring detail about that. Again, a lot of that can be woven into the story. It doesn't need to be kind of all pen to paper, if you will. The second one is when you talk about the product and what you're building and what it looks like, a demo speaks 1,000 words. It's easy to talk about this stuff abstractly and sort of what you're going to be and the vision and what your product could be and all these things and all that. It's much, much more impactful to see what it looks like. And again, this could be like a demo, screenshots, a working product if you have a working product, It can be thought through in terms of a sort of a use case or a specific customer. But if you could show off how somebody actually interacts with the system, that is usually far more impactful than talking about this stuff theoretically. The third thing is you want to show as much as you can demonstrable traction. So the easiest way is if you have a product that's out there that's in use today, talk about it. Talk about who's using it, why they're using it, how many people are using it, the value in the system, the number of the transactions. Even if it's small, having a velocity and showing that this thing is actually being used, again, is far more impactful than talking about this theoretically. And even if you haven't necessarily launched the product, you could also demonstrate traction. Like one of our seed investments we did was in FTX. Sam Bankman, before he even launched the exchange, he did a really good job of showing sort of all the stuff they were building up until the point of exchange launch. They did X, Y, Z, AA, all this sort of stuff of what they were doing. And it showed like there was a real, like the team was on a mission and they were doing something. They weren't just kind of talking about this. Like they were really making demonstrable steps to do this. Fourth, I guess, is being very clear on whatever or whoever your end user's use case and customer segment will be. This is usually very particular to the app or protocol, whether you're doing a gaming thing or a DeFi thing or an NFT. But as much as you want to show that you've really thought through who is going to use it and why. And then last but not least, just be concise and leave time for as much Q&A as possible. Because again, if you're just on the call and you just say your story for 30 minutes and then kind of you hang up and kind of leave, that's usually not the best pitch. You really want the back and forth from both sides. And again, most importantly, you, the entrepreneur, should be asking questions to the investor too, for you to understand, do you even want to move forward with this investor, and vice versa. Like it's really it's more of a dating relationship. It's not a one to many. It's a back and forth sort of thing. And then just a few, I guess, nitpicky things of things like I've seen on the receiving end a lot is one, unless you really haven't, don't forcefully try to induce FOMO. A lot of founders will sometimes say, we're raising $2 million, we already have a lead, there's $5 million of people chasing us already, you need to act right now, tell me yes or no. That usually doesn't leave itself for a good relationship on either side. Like you don't want a shotgun marriage. Like you want to make sure like you guys get along on both sides. Another one is understanding from the investor perspective which funds follow and which funds lead. There's a much smaller subset of firms who are willing to make the lead decision, put the terms on the table, and act without anybody else. There's a lot of firms that are willing to follow, and so you should sort of understand which one, and usually you need the leading firm first and then all the followers kind of afterwards. The terms itself, again, you don't need to go through all the stuff in the first one, but at least just kind of for us to know where you're at of how much you ideally want to raise, sort of what does that look like, even in broad strokes, to understand if both sides are a match for each other. Again, for us, we primarily do seed rounds, kind of average check $4 million. So if you're raising $100 million, we're probably not the best fit for you, and vice versa. So you probably want to understand that in the first meeting to see if it even makes sense for you guys to keep talking to each other. And again, I think I mentioned the last one, but really, like the entrepreneur, you should also be asking the investor lots and lots of questions to understand if you guys make a good fit. So I think that's it. I wanted to leave time for Q&A, sort of like I mentioned on a pitch. So if you guys have any questions, either about your specific position or pitching in general, or honestly anything from the venture side, I'm an open book. I'm happy to talk. You could raise your hand. I'll pick on you. I'll repeat the question. Don't be shy. Yeah. Yeah. The question for everybody else is, hey, I'm a student. I want to kind of learn more about the venture side. Sort of where would you start? As you mentioned, there was the really good book, Venture Deals, which goes into a lot more specific details about, I guess, how rounds are constructed and all that. Honestly, I would say a lot of this is more applicable to the Web 2 world of things. So I'm just going to move this so I can see you. Honestly, I don't know if there's a lot of things written from the perspective of DAOs and Web3s and a lot of this newer type stuff. A lot of this is more lesson learned in practice in reality as opposed to kind of being written down. Fred Wilson from USV writes a lot of good stuff. Like he has a blog that covers a lot of these things. The other way too is honestly having you being the founder, talking to other founders who have been through this process. Understanding the firms who have been good and helpful to them, the things they watched out for, the lessons they learned, the things they mistake. Actually talking to people who have been through this process, that's probably the most helpful. It's probably not so much written down, unfortunately or fortunately. But venture deals is a really good stuff, just a little bit more kind of Web 2 bent. I know you had a question too, so. Oh, okay, cool. Yeah. Yeah, I guess the question is from a student side that is kind of more on the business side that doesn't have or is not a technical co-founder, how would you go kind of approaching that from a venture side of things? One thing a VC probably cannot help you with is you finding a co-founder. If a VC says that, that should probably be a red flag because at the end of the day, the co-founder relationship is way more like a marriage than the venture perspective. And so the person you pick, you really, really, really have to trust the person. And so usually before, I guess, unless you're doing a really, really early stage accelerator, and even in that instance, usually most of the teams are usually formed by then. So I guess while you're at school, while you're at university, while you're going to hackathons, try to find the partner you would really trust and start building things, even if it's not to be a company, it's for fun, at a hackathon, whatever. Not because you think the thing's going to be the biggest thing in the world, but honestly just to see if you guys actually gel together. And if you guys like working together, and then you can kind of decide if you want to do a company together. But usually all this happens kind of before first pitch. I wouldn't necessarily go pitching if you're looking for a co-founder. It probably doesn't, timeline-wise, it doesn't make much sense from my opinion, I guess. Yeah. Simple question, long answer. Investing in equity versus tokens. This should not, in my opinion, depend on the investor. If the investor says, hey, even though you're doing token thing, we only invest in equity, so you need to change to be an equity company, that is a huge red flag. Don't ever take it from the VC. Sorry, I guess I'm speaking freely, but that should be more dictated on what you're building. If you are building a true decentralized network that has a computation layer where the token is a super core important piece of the incentivization network, then do a token and find an investor who's going to sort of back you on whatever that may be. The structure of what you're doing should be dictated by the company. Maybe with only one asterisk, a lot of companies in the pre-seed stage don't necessarily know at that point in time which one they're going to become. Some of them could become companies. They could become token companies. They're not really sure. In that world, a lot more common right now is a lot of companies do kind of a safe T structure. So normal safe round with a token warrant side letter. It's probably a little more technical, so I'm happy to talk offline if you want to grab me and kind of learn more about that. But in the pre-seed side, that's probably the most common structure if you have not picked an explicit route. But at some point in time, you usually have to kind of pick one direction or another. But that should be dictated on you, not our side.
Yeah, quick follow-up. Are token sales subject to the same SEC securities regulation?
Again, much longer conversation. Are tokens sort of considered the same SEC registration, sort of all that, as opposed to equity? No, they're completely different things. Some funds can invest in these things, some funds can't, some have to go through LPA amendments. Now we're at a much further, in the Web3 space today, there's much, this is far more developed. There's firms that are kind of known for a lot of this stuff. It's not as much a taboo anymore. But yes, there's major differences across both these asset classes. I wouldn't treat them equivocally the same. They're very different. Yep.
Yeah, so I guess there's something to be said behind, because this is a very compressed presentation. Lead investors, crypto natives, and then money. I mean, there's topics you could really cover. It's a good idea. It's crypto conference.
Sorry, can you speak up a little?
So sorry, so crypto native funds.
Yep.
preferable to dumb money generally. Well, it's a bad word, but like, generally that is the case. And then like having a relationship with lead investors is very important. It is that. So yeah, so all this stuff. You know, I don't know. You didn't talk about sort of or who to take money.
Yeah. So I guess the question was around sort of leads, co-leads, crypto native versus sort of more non-crypto native. Again, depends on the company you're doing. If you're doing a low-level layer 1 protocol, yeah, you probably want a pure crypto investor versus if you're doing more of a company thing. But I guess a few things. One, maybe the distinction. Leads are usually the ones that issue the term sheet. They're the ones that come up with the round structure in accordance or in partnership with the founder. And they usually act without needing other people to kind of chime in. So for us, like I don't need Paradigm to come with me to make a decision. I decide before them. We're sort of usually a few steps kind of earlier than that, if you will. On the whole sort of crypto native versus not, so two things. One, I guess there's what the firm sort of typically invest in. Two, there's reference checking the firms themselves from other founders that they invested in to see have they actually been helpful, have they said what they're doing. Because sorry, a dirty secret, we investors, if we want to invest in your company, we usually try to promise a lot of stuff that we're going to do. We'll help you with X, Y, Z. How much investors actually follow through on that is sometimes up for debate. So you should talk to the founders that they invested in to see how much they actually made true on those promises or not. You're going to get so much far better intel asking founders, not investors. And you should do your own homework do your own research on the investors too. And then last but not least, I kind of say the relationship matters a lot more because at the end of the day, all firms are people too. And so you want to pick the right person that you want to work with. Because even if you pick the firm, Sequoia or whatever, you're not interfacing with all of Sequoia. You're usually interfacing with the person. And the relationship between you and the person, whoever that partner is that's leading the deal for you, how much you get along, what do they do, what do they promise, how they are as a person, that usually matters a lot more than most people realize. And so it's not just the firm and the brand name, it's also the person you're really working with. Again, I could probably go on, but that's like the short version. And by the way, feel free to stop me if I have to go. One more question. Last one.
What do you think are the benefits and trade-offs of VC funding and like community funding through ICOs and NFTs?
Yeah. Also long question, but I guess the trade-off, or hard question, but the trade-off between sort of VC funding versus community funding and all that. I would treat, again, not all VCs would say this, but VCs are one funding source, but not the only funding source by any means. Even for traditional companies, not all companies make sense to be VC funding and vice versa. And so in the Web3 crypto space, you have a lot more freedom and flexibility and sources to pull from. NFT sales, ICOs, community sales, investment from DAOs. And so for where you are in your situation and what you need and what you're building, I would dictate who's going to do what you need, how they will help, and how they will deliver. And sometimes it could be the firm that is the best to do that. Sometimes it could be your own community, and you don't even need a firm at all whatsoever. That's totally fine. That is a decision that you and your co-founders need to make for yourself for what makes the most sense for you guys. I feel like a lot of times, a lot of people like to fetishize VC or sort of hold it up higher than what it is. It is a capital source, not the only one. So like you need to make kind of your own decision. And if a firm is what you want, then go for it. And if it's not, don't. Like don't feel peer pressured to do it. I guess that's my short answer on that. Cool. Thank you, guys.